Welcome, everyone. It's my pleasure to be joined by Liesel Pritzker Simmons at Columbia University's 20th Annual Social Enterprise Conference. Liesel is co-founder and principal of Blue Haven Initiative, where she oversees a portfolio focused on generating competitive financial returns and addressing social and environmental challenges. The portfolio spans asset classes from traditional equities and direct investments to philanthropic programs. I'm going to have a chat with Liesel on a number of topics around impact investing over the next 35 to 40 minutes, and then open it up to questions from the audience, and look forward to your participation and your questions. Liesel, welcome back to Columbia. You were here as a student and now here back virtually. I want to begin with a quote I read in the article in The Economist magazine, where that article described how you set out to create a family office with market rate impact investing as its focus. And the quote was, and I'm just going to read this directly, quote, "We wanted to do this not just because we thought it was the right thing to do, but also because we thought it was the smart thing to do." So let's start us off by discussing why you believe this is the right thing, and also why you believe it's the smart thing.
Sure. So great to be here. Thank you for having me. I think that I think it's a little easier to make the case that caring about sustainability and sort of the health of the planet and the people on it is a good business move. I think it's a little easier to make that case today than it was sort of, 10, 12 years ago when we were starting out kind of building this portfolio. Just look at what's happening in Glasgow this week. Look at, every corner of every conversation at large corporations and in governments is around what are we doing to the planet and how are people going to live on it, without sort of burning up and in a sustainable way. And not just environmentally, but from a social justice standpoint and environmental justice standpoint, you sort of can't deny that these things are huge risks to business, but also huge opportunities as well. And so I think, the world is sort of, caught up with that thesis as well. And if you take a sustainability lens across your portfolio, and if you have done over the last 10 years, you would outperform. You've got some of the best, whether it's public equities or, things happening in climate tech. There are a lot of real business opportunities that markets can help to scale, and I think investors should be turning to. And I think you get better talent also when you start focusing on sustainability as well. The smartest people in the world that I know are paying attention to these issues, again, because they're interesting and they're pressing and important. So I think when you're focused on funds and on companies and different investment strategies, you also just get smarter people. And so that to me is a big part of our investment thesis as well, is we want to be with the top talent. And so, yeah, so those are some of the reasons why I think it's a smart thing to do. And I think all the usual boring reasons as to why it's a good thing to do. I'm a citizen of this planet. I don't want to see it burning up. I like people too much. I like nature too much. All the same kind of relatively boring reasons for
all those so-called impact reasons. I want to talk
right. All those feel-good tree huggery reasons. Yeah. I've got children, all that. So, I also do think there's a good business case, and luckily that case is getting easier and easier to make these days.
Right. We'll come back to business case in a second. You mentioned employees, and one of my colleagues at the business school, Professor Vanessa Burbano, she did a study a couple of years ago now. It's probably about 5 years ago. That it was a study to see whether or not employees would prefer to work for companies that they view as sustainable. And the response was strong yes, that in fact they would work for a lower wage for companies they believe are sustainable, or in a competitive job market, which is where we are right now, that employers can hire better employees, which is what you were talking about. You can get the best team. by being viewed as a more sustainable company. So I think the research data supports your experience in that regard, which is good to see.
Excellent.
And your point about social trends, climate change, I mean, society does seem to be heading the right way on many of these issues. So given that, what's the impact investing focus of your portfolio?
Sure. So, Blue Haven is, we're a single family office. And so it's me and my husband are the principals. And, we run a diversified investment portfolio. So kind of spanning asset classes, and spanning different themes, but everything is intentionally chosen because we like its environmental or social, sort of focus area alongside what it's doing financially in the portfolio. So everything in there has been intentionally selected around that. And that looks different, right? Like, your sort of your ESG impact portfolio in public equities looks really different than, your seed stage investments in your venture portfolio. But, roughly speaking, we take all of those parameters into account. And again, like I said, we are trying to look for where sustainability themes, regardless of what they are, whether they're on the sort of social side of ESG or in the environmental side, are actually driving the investment opportunity. So instead of kind of, here's an idea and here's sort of a layer on top, we try to look as much as we can for where the actual investment opportunity, the impact is sort of embedded into the investment opportunity. So you start to see themes kind of emerge from that, because markets are really good at scaling some kinds of solutions and really shit at scaling other kinds. So we've seen our portfolio, we have whether in different asset classes and different approaches, a lot of exposure to renewable energy and clean energy infrastructure, because markets are willing to pay for that, which is kind of interesting and exciting. And then we also have seen, again, across asset classes, but a lot of kind of financial services, financial inclusion, insurance products, sort of financial services. And so I would say we have seen these themes kind of sort of pop up. We have less exposure to, I'd say, education and healthcare, but a little bit more on the health side, on some biotech, some digital healthcare. Less on education, not because we don't love it, but because we haven't found as many wonderful opportunities where the scale of the enterprise and the impact that it has are really nicely knitted together. Education is something that, I don't know, as a society, we've decided needs to be subsidized and we don't really value, even though we know the benefits of it. So as an investor, that makes it tricky. I can't solve that problem with my investment portfolio. And so those are some of the themes that we've seen. So we sort of look across asset class. I mean, our asset allocation, looks broadly similar to kind of an endowment style. We're probably a little bit heavier on the private side than a typical endowment, probably more exposure to emerging markets than your typical US investor, at least.
But your entire portfolio then is under that impact investing umbrella that you described, from ESG to impact first.
Yeah.
And that's pretty unusual even today, despite a lot of people doing impact investing. Is relatively few investors who are looking at it from a portfolio perspective.
I mean, it is. And that's certainly, I mean, there's luckily a few more, and I think family offices are kind of, for many sort of reasons, it's a little easier for us to do it than some other sorts of institutional investors. But I mean, from my perspective, is like either you agree with this or you don't. Like, I can't be a little bit, I have a hard time assigning this to just a piece of the portfolio, because I genuinely believe that this is where the world is going. And I like to have conviction as an investor. I think that's a weird thing to hedge, of like, and this part of my portfolio, I do think the world is burning down, but over here, I do not. Like, that doesn't work for me. I can't like be a little bit pregnant. Like you have to, you have to sort of do it. So for me, it's just clearer. The other reason is that I think once you start using this lens to evaluate opportunities, you start to realize that it is actually more rigorous than what we were doing in our traditional portfolio prior to this.
And explain that in a little more detail. But just before you do that, I do want to say this concept of you either believe or you don't. This is very insightful. I haven't heard it framed that way before. I like that a lot. I mean,
well,
no, it's a good point. You either do or you don't. And if you do, why wouldn't you?
Why wouldn't you? Yeah, to me, I have a hard time with that like mental model.
Which is a lot of historic context there, right? Historically, people thought of maximizing risk-adjusted returns and then giving money away.
Right, exactly.
Had a hard time. So it's almost a right brain, left brain thing. You know, how do you bring?
Well, and that's exactly right. Like if you believe that, then you can understand why not caring about or not wanting to take responsibility for any sort of like extra financial externalities is irritating. But my problem with that model, right, of the like maximize returns and then over here maximize impact is it seems like extremely fat accounting to me. Like, why would you only get credit for the impact you have over here net of all the crap you're doing over here.
Right.
So from a, like, don't you want to reduce your expenses first?
Yeah.
And then go over here and you can maximize your profits? Like you can't, that doesn't, to me, that seems like a very inefficient way.
Yeah, two sides of the ledger. As you're saying, you should look at the whole ledger together.
Yeah, just look at like start from, let's be a lean company from a negative impact perspective.
Yeah.
And then we get to do more interesting stuff over here because we don't have to undo all the crap we did over here. Yeah. Just seems like a lot of unnecessary work. If you start from the beginning.
Yeah. Seems
so that's
sort of more rigorous and how, why that makes sense. So tell us more about that.
So I think that this style of investing, yes, of course, we're looking at all of the sort of traditional financial elements and risk elements that you'd look at in a normal due diligence process for any sort of an investment. And we look at comps and we look, all the stuff that you do in your normal kind of due diligence questionnaire. But then, there's other things you want to take into account. You want to look at, how is this firm, managed? Who is making investment decisions and what are their backgrounds? And is it equitable? And, or is it only, sort of 4 gray-haired white guys who are making all the decisions? Are they missing something because there isn't a balance on their investment team? I mean, things like that. And then all the way down to what is the investment actually doing? Is it taking, if it's a real estate investment and they're not looking at, how climate is going to affect their assets, or they're not even considering climate risk and where they make investments, probably not a great manager, like
who you want to put your capital into. Yeah.
Exactly. So it sort of opens up more areas of questioning and of analysis of a certain manager or a certain strategy that traditional investing is sort of too narrow for. So that to me, it sort of widens the aperture of analysis for any given deal. And traditional investing to me is just, a bit narrow.
Yeah, now that certainly aligns with some of the research I've read on how ESG factors, environmental, social governance factors, are very complex to manage. These are actually challenging issues, and that maybe companies that are really good at managing them, and fund managers are really good at managing them, are just really good, period.
Yeah.
if they can manage that really hard stuff, they can probably manage a lot of things really well. And in some ways, maybe proxy, almost like being good on impact issues is a proxy for just being plain good.
Yeah. And I'll take it. You know what I mean? Like I I will take, maybe they're just better managed companies. Terrific. I don't get that's fine. And I do think though that those companies, and I think investors generally, I mean, what we like to do, and again, on like the metrics and sort of evaluation side is, and there's good work being done on this. It's still super noisy, I think, but like, which of these various ESG metrics are truly do matter and are truly material to the financial performance of a certain company? And I think it depends on the sector, but some of these things, like, you know, companies that score higher on the G side, right? Well-governed companies tend to be valuable, right? It's just a good thing all around to be well-governed. So I think that I really am watching closely, and I'm excited about more research being done on which of these metrics are truly material to performance.
And it's the materiality that matters. One of my colleagues at the business school has been pretty skeptical of ESG for a while, simply because the measurement systems are well, very poor, right?
Yeah, it's 100%.
Like what he concluded is the issues themselves are truly material to the success of these businesses. So it's not a question of, he's concluded ESG actually has a very important role to play in investing in companies, but we got to get a lot better at measuring ESG, and that's
well, and also I do think that there is a rush to, like, it feels like with impact investing, like everybody wants, like, they want a list, they want everything to be perfectly ranked, like, which is the better company, just tell me, so that, you know, like, there's this rush to simplify all of this information instead of saying, this is a data point, now you take it and you go do the work. And also that even on, you know, that we're sort of holding ESG metrics to a higher standard than some traditional. I was just reading, someone had like Uber's finance report, and it took them 1,300 words to describe their adjusted EBITDA.
Yeah.
Just as disclaimers for like, this is what's in it, this is what's not, this is what's in it, this is what's not. And it's like, that's over on the financial side and they can't get it together. You know, ESG.
I mean, working on those financial numbers, those metrics for 500 years, like accounting, you know, it goes back 500 years. And
yeah.
I haven't read the Uber report, but it doesn't surprise me at all. Those financial numbers don't tell us a lot about
it's a starting point, right? It's a starting point for an analyst to then say, okay, well, here's the information. Now let me put my thinking cap on and actually understand what this means and form a point of view on it. And so now I do agree, though. I think there's just the raw ESG data needs to get better.
Needs to get a lot better. So one of the big challenges of this sector, when I say the sector, sort of impact investing broadly, is, you know, measuring the inputs, the ESG numbers. What are we trying to determine? And I do think people's expectations, you know, are a little bit unrealistic. But the other big challenge, and sometimes the bigger challenge, is how do you measure the output, specifically impact? Right? And there's a lot of discussion around this issue. How do you measure impact? And again, I think it's fair to say we're not that good at it yet. But what are your thoughts on that topic? How do you at Blue Haven think about measuring impact? What are your thoughts around that issue? So,
I mean, there are many different methodologies, some borrowed, you know, a lot of it borrowed from sort of international development and things like that around how to think about, you know, just take a company at the company level. You know, what is this company's sort of intervention and what is it doing and how do we measure that? And you know, I've seen everything from like RCTs done on companies that are, you know, the gold standard of verifying kind of what happened with that particular intervention, but they're so insanely expensive. It's just not realistic to sort of keep them up, you know, down to, you know, just sort of more qualitative kind of flash surveys. I think there's a lot of kind of lean data approaches that are happening now. 60 Decibels is doing a really great job with that of how do you basically combine sort of customer insight
Mhm.
with impact as well. And so how do you use those impact metrics to inform a better user experience or a better customer experience, to understand what happens? So I'm seeing some good stuff happening there. So some of our portfolio companies have used those types of methods to get a handle on what's going on. We have also used at the fund level and at the enterprise level, when we're doing due diligence, we try to work closely with the management teams and set up, what are some metrics that again are tied to the business model that we can track against. And some of these are more outputs than outcomes, as irritating as that is, but it's also it's hard to tie specific outcomes to a specific intervention. Prior to kind of running this portfolio, I was working at a foundation that was focused on financing for low cost or affordable private schools in Ghana. And one of the things we were looking at combining with the loan product was, teacher training. And I remember like going down this rabbit hole of the relationship between training teachers and kids learning more and kids testing better is like tenuous at best. And that's even for like straight education interventions, let alone, we're a loan portfolio essentially. And so that thread becomes very thin, very, very quickly. So what we try to do is kind of get a handle on what is this investment trying to do? What is its good or service? Is that good or service helping people, and in what way? Who is it helping? How is it helping them? And how do we make sure that helping more of those people better actually means our bottom line is growing? So
there's alignment between the impact and the financial.
That's what we try to do is always, we're not development experts, we're investors. But we want to make sure our investments are at the very least not doing something bad, but hopefully doing something good. But how do we sort of manage towards that? So, how does that show up essentially on the sort of the business documents that we're going to look at in a board meeting? And we try not to be onerous with that. We're not a development finance institution. We are a family office. So, usually in many of the deals we're in, there are more, there are investors that have frameworks that are more onerous than ours. So we are very happy to piggyback on IFC's operating principles and other things as well. But we try to keep it relatively simple, kind of 3 to 5 things that we think are really, really key for this investment that we're constantly watching. But that's easier to do at the enterprise level. At the fund level, that's still okay. But then when you start moving into public equities and you start moving into like other alternative strategies, the other thing we've learned from a measurement standpoint is we're never going to get the one beautiful rolled up dashboard that like is this like holy grail for portfolio level impact investing. It just is meaningless. It doesn't mean any, like I can't compare how generation investment managers and their large public equity portfolio compares to Elevar, which is a sort of tech-enabled global emerging manager. Like it doesn't help me as an investor. They each have their impact reports, but trying to combine everything together does not make me make better investment decisions. And so that we have put that to bed for the moment of trying to get everything like beautifully rolled up, and we do things more. The sort of unit of measurement is usually the fund manager for us. And then we do have a direct investing portfolio. Then that's a little easier because that's a bit more concentrated.
You're a bit closer. Yeah, no, that makes a lot of sense. I mean, I do think if you're only looking at financial returns, it's pretty simple. There is an apples to apples comparison against funds.
Right.
Getting into impact, I think trying to, as you said, sort of force that dashboard, that apples to apples comparison is probably, to get fruit salad, to use a lousy.
Well, and the other thing for us is we are looking to build a diversified portfolio. So, and I mean that from a financial perspective, a risk return perspective, but as well as an impact perspective.
Yeah.
We learned actually, it was, I can't remember what year, but a few years ago, that actually renewable energy prices were actually tied to oil prices. They weren't disaggregated, and we were a little over concentrated. And
Right.
so we actually, from an impact perspective as well, want to watch that. And so it's not like we have one portfolio where we're comparing, these different, malaria interventions and which one gives us more bang for our buck. In that sense, you would definitely want something that rolls up so you can really look at which, what are you getting for that investment style? But we have intentionally tried to diversify. And so the rolling up makes even less sense from an impact perspective.
That does make a lot of sense. Yeah, absolutely. So you mentioned investing in solar, and just before we got on the call, you mentioned before that we started on Zoom here, you mentioned that you just were in Nairobi recently, and I'm impressed you're able to really travel with the pandemic. That's fantastic, actually. But just take it sort of a level deeper. What is it that excites you about investing in that region? Where do you see the financial opportunity, the impact opportunity, and also many challenges exist in doing that? And if you have a specific example or more generally, just tell us a little bit more about what your experience is there, and in terms of your direct investments, because I know you've direct investing there.
And so this part of the portfolio, so starting in 2014, we sort of carved out $50 million from the private equity portfolio to do direct investing. And the thesis of that portfolio, so it's sort of styled as kind of, it's our own internal, it's a kind of an evergreen fund, but looking for, VC-like companies, venture companies, and focused on sort of tech-enabled businesses, mostly kind of fintech is where we've ended up in sub-Saharan Africa. And about half of our portfolio is in East Africa and half kind of in West, a little bit in Southern Africa, but mostly East and West Africa. And the reason that we chose that as a thesis in 2014 was we were starting to see a proliferation and high adoption rates of mobile money. And when you have, a population that is underbanked with bad incumbent banking systems that you don't need to overcome from a competitive standpoint, and deep comfort with using digital currencies, we thought, and it's played out, that would be a really interesting fintech scene. And it has been. And so, but we look at sort of different facets of that. So some of it kind of asset finance, which is, so starting with pay-as-you-go solar, which, as we were talking about earlier, I think is much more of an asset finance play than an energy play. But I like that it's actually collateralized as opposed to some of these consumer lending platforms that are just, everybody's over indebted and gambling, and it's terrifying. So I like collateralized debt, but in a way that you can sort of get to underbanked populations. Then we're also seeing, other kinds of like logistics platforms like Twiga Foods we're in another one in Nigeria called Field Intelligence that does logistics for pharmacies. So essentially a pay-as-you-sell model for inventory and drugs and inventory management. We're investors in Paystack, which was a payments platform out of Nigeria that Stripe just acquired. So like there's interesting movement happening, and people are starting to realize that sort of African fintech is an exciting place to play.
Yeah.
And not that fintech is always the same as financial inclusion, but we try to find where those things kind of intersect. And so that portfolio has been a lot of fun to kind of watch and grow. And it almost feels like there's a whole new level of interest happening with the explosion of sort of crypto on the continent as well. There's a huge volume of sort of crypto transactions as well. So we're seeing a lot of movement in that space, which is exciting, but also, from an impact standpoint, I have not yet fully formed my opinion of where crypto sits in this space. If you can promise me that it's not pure speculation and that it's not going to fund God knows what, I don't know. So I haven't.
I can't make that promise. I don't know.
I'm still in learning mode.
Look back, on
where we want to play. Yeah.
No, thanks a lot. The mobile revolution. I mean, what's happened with mobile phones and is really shocking. I mean, there's very few places in the world, sub-Saharan Africa and elsewhere, where I've seen you don't. Everyone has a phone. It's really remarkable. Everyone has a phone and access to a Coca-Cola if they want to buy one, which talk about impact and negative impact, but that's a whole different story. But really, really remarkable things being created, like financial transactions building off the back of that. What are some of the challenges that you run across when you try to invest in these companies or as those companies try to scale and grow?
So I think the biggest challenge, where challenges are actually fairly boring business challenges. It's, what does our sales strategy look like? What's our pricing? Like, it's actually super boring, regular business stuff. How do I find a CFO? I think is probably our number one business challenge.
Finding talent can be a real challenge.
Finding talent, but not even the skill sets, but it's also being able to manage it properly. When you are, and you see, because these are tech businesses, right? So, it's the same way you get this like hotshot 26-year-old, they're computer science, they're engineers, right? And they don't necessarily know how to manage 1,000-person, sales force. And so it's actually the boring stuff and it's the not tech stuff. I think that the hardest part in our venture portfolio is that, it's usually not a tech problem, right? When something goes awry or something goes sideways, it's a
basic business problem.
It's a basic business problem. And so the other thing I think that is also difficult, less so for the companies themselves, but particularly for investors that are new to these markets is, they kind of like look at a map of Africa and believe that they know where the natural expansion countries should be, or like, they're like, oh, you're in Kenya. Well, Ethiopia is very close and has a very large population, so we should go there next. And anyone in Kenya will be like, that's not right. It's probably going to be easier to go to Nigeria than to go to Ethiopia right now. So I think some of those, some of the idiosyncrasies of the particular markets and where things can go to expand. And a lot of acquirers are looking for a Pan-African play that people have had a hard time building up yet. So I think those are some of the challenges.
Yeah, that's a good point. I mean, Africa is extraordinarily heterogeneous, diverse, different political systems, different cultures, languages, everything. It's a really large area. Terrific. Well, I'm glad to see you guys succeeding there and making some really interesting investments. I just want to sort of a little bit the bigger picture and theory question for you. I know that Blue Haven invests partially as a catalytic investor, and catalytic in this case being defined as, capital that's accepting either above market risk or below market return, and this is the key point, with the objective of bringing in more traditional commercial capital. Right? And talk a little bit about why you try to be a catalytic investor, and also what some of the challenges are to being a catalytic investor.
Sure. Yeah, so I mean, as you say, I mean, that's basically that's the same definition we use, right? Is where is there not a risk-adjusted return now, but possibly, I mean, either is something we think will have that, but there's things to be worked out before that, and we're willing to accept that risk or accept that lower return, because we do think that it's worth it in the sort of against a time horizon. Yeah, because I think there are some things that could be market sort of based solutions, but aren't quite there yet, or the market hasn't figured that out. So some areas where I think that's interesting, although it's sort of, it's kind of catching up, is particularly on some of the hard tech, climate tech solutions. I think people are more willing to take on the technology risk today than they were, I mean, even 4 or 5, let alone 10 years ago, where everybody got sort of scared away from clean tech. And essentially any tech, any sort of climate related play, they really wanted it to look like Nest, right? They wanted a software solution to what is ultimately, a chemistry and a physics problem. And so those are places, right, where we see there's capital, there's sort of more traditional VC waiting on the sideline, but they need somebody to build the demonstration plan, and they don't want to do that. And so, things like that, where we think, or some of these new technologies that do need to build pilot facilities, but everyone knows how to underwrite a solar project or a wind farm, but you don't really know how to underwrite, taking heat off of massive industrial complexes and turning it into energy. Like, is that a PPA? Like, what does that actually look like? And so, so those are places where we say, okay, you know what, we're not sure what the risk return profile of this is going to look like. But we'll go ahead and do it because we think it's worth it, and we'll see what we learn. So I think, so we've started to do more of that in our portfolio. Mentally, it comes from our grant bucket, yep. Even if we do make some returns as well, but just from an accounting standpoint, it's helpful for me to have kissed that money goodbye. But we've started to do more and more of that. And in terms of challenges, I think the hardest part is all these different catalytic investments all look different. They are weird by nature. If they weren't weird, somebody would have figured them out in the grant port, like they would have sort of been figured out. So they often look like these strange kind of weird opportunities.
They were easy, someone would have done them.
Well, right. And so I think, again, we tried for many years to have all sorts of like very pretty frameworks, and like, here's a lovely PowerPoint deck around like, here's how we think about these things. And every time something then comes across, we're like, well, that just blew the framework apart. Right. But we still think it's cool. So I think coming to terms with the fact that just not wasting a ton of time crowbarring something into a framework that sounds really pretty but has no deal flow.
Right. Sounds like what you're saying is just get out there and do it and learn, prove as you go, and not get too stuck on the theories as you go along. So I want to take questions from the audience. There's a couple questions in the Q&A box. If you haven't put anything in there yet and you'd like to, please do so, and I will get to your questions. While we wait for questions to come in, let me ask Liesel you one last question from me, which is, impact investing is very hot right now. It's a popular term. Lots of people calling themselves impact investors. Real range of institutions, real range of characters. What are your thoughts about that? I mean, you were there early. You were one of the earlier folks in committing to this, believing in it. We talked about believing in it. And now you see all these new players rushing in. How do you feel about that?
I'm okay with it. It's funny. There's some, some of my sort of like fellow travelers over the last decade or so are much more kind of curmudgeonly, like, who are these people? We've been doing this for years and these hot shots are coming in. But I'm okay with it because for me, this isn't a trend. Mm-hmm. I understand that it is, but I genuinely believe this style of investing will, give us superior returns. And I think it also lets us know the limitations of markets, right? Markets aren't going to solve, us breaking out into a civil war. Like, that's not a market problem. We still have to learn how to treat each other nicely. So it's also, I think this style also just lets you know, when you're honest about it, what the limitations are of what financial markets can do in terms of making the world a better place. But for me, it's really not a trend. It's a method of looking at how to select investments. And so for me, all these folks coming in and, slapping the pretty SDG logos on stuff and all that, I think the market will sort itself out. I think the cream will rise to the top. But the other thing is that, buyer beware. If you're looking at a fund from a manager that has a reputation for not necessarily being the most thoughtful around impact, but they've got this gorgeous impact fund, look under the hood and see for yourself if you think this is sort of bullshit or if you think that there's something legit there. And so I think, the onus is on the asset owner and the allocator to hold their feet to the fire. And I mean, my one thing with the large firms that are coming into this space and building out funds. So on the one hand, large institutional investors and sovereign wealth funds and pension funds and all of that are much more likely to kind of jump into this space when they're working with a manager that they've known for 30 years and they've already been in a ton of their funds, and here's now their impact product and they're like, oh, okay, well, if it's from you guys because we know you, that's okay, we'll go into it. And I think that's great. That is a good on-ramp for a lot of those really, really large allocators to start thinking about this. My one thing though for the firms is that, back to what we were talking about earlier, you can't be a little bit pregnant. If you genuinely think that impact is going to deliver superior returns and you're selling that fund based on that, what about all these other funds over here? How are you, if you're selling this, you also then have to sort of account for what this is as well. And so why aren't you doing that over there if you actually believe it?
Exactly. You believe this, why am I not taking a holistic approach to this? That makes sense.
So that's been when we have looked at these funds that have come from the really large firms where the vast majority of their business is not in impact, that has always been the sticking point for us, is that the fund itself in a vacuum looks awesome, but we haven't been properly explained why there are two different frameworks if you genuinely are telling us we're going to get good returns over here. So, and I just can't.
Makes a lot of sense. No, absolutely.
So it's not a principle.
It's an awkward conversation sometimes with cheers, but sounds interesting. Well, I do try to explain to my students that if you see an impact manager who promises to change the world and make you a lot of money, you have to wonder how honest they're being. Use the word honesty, because being a successful investor is hard. It's hard to generate good returns, and it's hard to change the world. It's hard to make the world a better place, and doing them together isn't necessarily easy.
Well, and I think the more esoteric conversations at our investment committee level, and then just more broadly, just within our family office and sort of between me and my husband, is this issue, the issue at hand, whether it's a company addressing something or a fund or something else or a nonprofit that we're talking to, is the problem. Is it a business problem? Is it a market problem? Is it that, we can't get this to the people who value it, or there's too many middlemen? There are a lot of things that are market problems. Absolutely. And that's where I think impact investing can play. But there are a lot of things that are not market problems. And then I think not just impact investing, but business in general should get the hell out. And leave that to civil society, and leave that to our sort of social frameworks to address and to fix.
Yeah.
You know, the metaverse is not going to fix polarization in this country. Like, it's just not, you know.
That conversation will take us a lot more than the 15 minutes. Speaking of which, 15 minutes left. I want to get some of these questions here. I see we got a bunch in the chat box. So, or in the Q&A box, excuse me. Elena asked a question. It's a long question, but really what she's talking about is which investment sectors can you have impact? You mentioned education is one where it's tough to measure impact and really determine the causality, really, if your investment goes in, how much impact it's having. She suggests, are there other areas where you could demonstrate more returns, perhaps healthcare, where you can get financial returns and measurable impact? What are your thoughts on that?
So, yeah, I mean, yes, I think that's a great question. I think that healthcare, and this is one we've wrestled with ourselves, is that what's the right kind of, there's what's possible, and then there's like what would be an ideal interplay between private sector and public sector when it comes to healthcare. So, you know, I think when we've invested, so like we've got one digital health platform in that's in Nairobi called Tibu Health that does, you know, kind of like home services. I mean, obviously a lot of COVID testing now, but the vast majority of sort of tests that you need can be done at home and can be done relatively cheaply. Those kinds of things that actually it's really getting a motorcycle driver to the home with the right equipment and then getting back to the lab. It's kind of a logistics kind of digital health play that is better for patients and better for doctors and easier than getting people to, you know, different clinics and facilities and sitting in traffic for forever getting there. So they're more likely to have better health outcomes because they actually get the test. Yep. So things like that are they're limited, can grow, but they're in partnership with other clinics and it's covered by insurance in many cases, things like that. Yeah. I think are some low-hanging fruit for the health sector. But then there's things, so another company we're invested in Kenya, which is really interesting, is a company called Flare, and they're basically the 911 for Kenya. And so, but what they're trying to do is take independent, most ambulances, sometimes clinics will own an ambulance, but most ambulance services are independent. Right. Someone has 2 or 3 ambulances, and they all have different sorts of equipment and different levels of training, and they are in different parts of the city. And, you know, you aren't going to call, 50 different ambulance providers before you start before you get your ambulance. So most people just bring themselves to the hospital if there's, which of course from an emergency medical response situation is a disaster. So Flare is the logistics platform and training platform for all these different ambulances. And using, all of the benefits of tech is actually very helpful, speeds things up, gets the right ambulance to the right person and brings them to the right clinic. Yeah. Things like that, where time is of the essence, and it really, really does matter. So I think that there are good parts of various parts of the healthcare system that are desperately needing some private sector innovation. But when it's all private, I think, we see what happens in this country when you have, private sector mechanisms that are really screwing up the healthcare system too. So I think there's a finite place to play there.
As you mentioned, education is a hard one with private capital too. It's hard to find that fit.
Well, and it's hard to do it. You can get good delivery, but then there's an equity issue usually. A lot of ed tech stuff is sort of selling to like rich yoga moms like me. You know what I mean? It's not educating a child with special needs in an inner city with a single mom who works 3 jobs. You're not going to get VC returns. You're just not, it's not appropriate. So I think those things are harder to find risk-adjusted returns in. And this should be, that's what, you shouldn't expect VC returns.
That brings to another related question. There's sort of two parts to this question. One is, how do you decide between direct investment? How much of your portfolio, since you look at it holistically, is direct, decide between managers and direct? How do you sort of think about that split? And also, how do you think about philanthropy in terms of incorporating that into your way of thinking? Because as you said, there are certain issues that, there has to be philanthropy involved, or you're just not going to find a market solution.
So in terms of the split between direct and managers, I'd say the majority of our portfolio is really with managers, with the exception of that kind of $50 million carve out that we do in-house. And a large part of that split, and again, one of the incredible luxuries of being a single family office, is that we split it based on what we love and where we want to spend our time and where we want to build expertise. So I'm totally passionate about fintech and tech-enabled services in sub-Saharan Africa, which is a massive thing in and of itself. But so that's where we want to build up our internal team and build up our capabilities on the direct side. Muni bond manager selection, while it's a very important part of our portfolio as a taxable entity, not my area of expertise, and I'm very happy to sort of outsource that fund manager selection as well. So that's kind of how we've sort of split it, is our direct investing in philanthropy is done in-house, and then we work with a team of investment advisors on fund manager selection. That's how we've done that.
Your thoughts around philanthropy and how that fits in, how you sort of balance that?
I mean, I'd say there's kind of two main areas that our family office focuses philanthropically. One is on kind of impact investing, ecosystem building, so sort of like public goods associated with impact investing. So there's a pooled vehicle that we're part of now called the Tipping Point Fund that has done a lot of work around, it's like us, Ford, Rockefeller, Omidyar, MacArthur, some of the people who've been trying to help build this industry for a while, and things like grants too. So I don't know if anybody was closely following the IFRS has now combined, I'm going to screw up, it's such an alphabet soup, but there's good movement happening, as we were alluding to earlier, on ESG disclosures, and there's various different projects that have sort of combined and put out some protocols, which is super, super exciting. So things like that, like the actual back end of how that got to happen, was very much philanthropically funded, and we helped participate in some of that. So things like that, like getting the pipes going for impact investing. Some of these sort of investor networks we've given to philanthropically to sort of bring more people into the room. But then the other very big part, which is really where my husband spends his time, is on things we really care about that markets should play zero part in whatsoever. And so we're so a lot of his big passion areas is voting rights and getting young people to vote, getting young people of color to vote, getting them to vote in primaries, so that you don't just have old white people setting agendas. Like, how do you kind of, small d democracy building, and campaign finance reform. We've been huge proponents, this is a whole other thing, but big proponents of tax reform and raising taxes on people like us. When our effective tax rates are like under 3%, it's kind of.
I've had some press on that, which I think is fabulous. It's
so
tax code in this country is very strange.
That's where like tech bro Twitter and I diverge, and so we're all on the same page. And then I'm like, and taxes, and then they're like, go away, and so. Those kinds of things that we think are broadly good, but there's no, it's not investable. They're good things, but they're not investable.
No, that makes that perfect sense. I'm glad you're doing that work, you and your husband both. Very important as well. So I think probably our last question, we only have a few minutes left, but I think an important question for many people listening and also came up the QA box, which is around careers in impact investing. And so my general question for you is, any advice for students or recent graduates who are interested in perhaps a career in impact investing? And there's this specific question in the Q&A box, which is, what about those who do have sort of a non-traditional journey into impact investing? For a student who doesn't come from a finance background or perhaps hasn't studied finance, any thoughts on careers in the sector?
I mean, I think that, I myself, like, I don't have a finance background. I was a history major, which I think is a great major anyway. But I also don't have a finance background, and I finally, at 37 years old and running this portfolio for a while, have like just only like earlier this year gotten over my imposter syndrome that like maybe I actually do know a little bit. But I think that there is, definitely this is still investing. I don't have a finance background, but most of my team does. So I think that is important. But I think also where I get impressed with people is when I can see that they have done their homework. One of the parts I find the most, I know this sounds like a really silly kind of boring answer, but where I get really upset is when someone assumes that if they haven't heard of something, that it doesn't exist, or that nobody's tried it, or that it hasn't happened before. And so that's where I see some people who maybe like they have a more traditional finance background, but they sort of make these grand sweeping generalizations that make it clear that they haven't really done their homework in what other people have done before. Right. Or read the reports or gone down the rabbit holes and looked at the footnotes and sort of, I think that's important. And there's more and more to keep track of today than there was. So I think that's important. I think that, as an investor as well, more and more, I think people are really seeing the value of having operators on their team. I think that's a big part. So if you have an operating background, like that's great. That's really great in terms of getting into impact investing, because that's really where the rubber meets the road, and people are looking for useful members of their team on that.
I couldn't agree more. I think getting experience, social venture experience is terrific.
Yeah. And there's a lot of different ways into it, like there's, being part of a large corporation that's starting a sustainability team. Like that's really important insight as well. Or when you are part of a firm, we've hired some folks who've been frustrated coming from larger corporations where they were kind of siloed out because they cared about this.
Yeah.
And they want to be somewhere where it's more holistic. So I think there's a lot of roads in. There is still definitely a finance component and an investing component that is important. Yeah.
Well, thank you for that advice. And more importantly, thank you for joining us here today.
Thank you for having me. This was really
wonderful having this conversation. Really enjoyed it. Appreciate all your insights. And it's nice to meet a true believer across the spectrum. That's terrific. I also want to thank all of today's speakers, volunteers, co-chairs, center faculty, and staff, and of course, all of you for joining us online today. It was an inspiring day hearing from our keynotes about the unique and innovative ways in which they are deploying capital to have social impact in our society. Whether you are part of a nonprofit, a philanthropy, a social venture, whether you feel passionate about healthcare, mass incarceration, ed reform, climate change, affordable housing, or international development, we all have a responsibility to invest in the future. We hope this conference has highlighted the various opportunities available for you to use capital for good. You can hear from more corporate and civic leaders on the intersection of finance and social enterprise by subscribing to our Capital for Good podcast at bit.ly/K for Good. Thank you for joining us. Thank you again to Liesel. Look forward to seeing you at future events. Take care.